right.
Thank you. Good choice.
Welcome to the family table. This concept was birthed when I got into the business, and I remember they told me, I was pretty young, they said, Sonny, one day when you grow up, you're going to be able to go to the boardroom table and meet with people there. And I finally grew up, and I've been after this now for about 26, 27 years, and I figured that the real conversation is really happening at the family table. So we created this space here we call the family table, just to have some great conversation and do workshops like this. So welcome, I'm so glad you guys are here. For those of you that don't know me, my journey started in this most beautiful, beautiful country. But I remember very specifically the phone rang, and my mother was on the other side of the phone, and she was crying. And I remember that very distinctly, and I was very worried about that phone call because I was wondering if anything happened to my father. Well, my mother basically was sharing with me, she said, son, that very, very important accounting exam that you were studying for your finals, I got very sad news, you failed your final accounting class. And that meant you failed your whole entire year. Well, that was a problem. But before I tell you about the problem, I remember driving to that accounting class. I was down the highway and I had two thoughts. One, I hoped I studied enough because this was the big one. This is the fourth year and it was covering all the work that we covered in the first 4 years. The second thought I had is like, gee whiz, I don't really like accounting. To me, accounting was really at that point in time, recording the past. And I was driving down the road and was thinking, you know, one day I'd like to use all this great training and help people shape their futures. But I thought, there's no profession like that. So I drove on, I wrote the exam. The next day I got on a plane, the second plane ride of my life. I flew all the way to the United States because that time my girlfriend was in the United States working as an occupational therapist, and she was on her adventure, and she bought me a plane ticket to come to this great country. And during the time that I was here for about 2 or 3 months, I didn't come with a ring, but during that time we got engaged. And after we got engaged, we called our parents and we were on the top of the world. And literally 2 days after that, the phone rang and it was my mother. And she was giving me this bad news. Well, I thought, what would I do? I went back to South Africa. This is the city that we were born and raised in. It's the most beautiful city in the world. This is Cape Town, South Africa. I went back there. I moved in with my parents from this beautiful wine farm. And I really had to humble myself. I was immediately moved in and I was going to pay rent. And I worked and I did some work on the side while I was redoing this whole academical year. But I still had this gnawing feeling inside of me that said I really don't like or want to do really accounting. So I was going to get married in the year, and the only thing that made sense to me to do at that point in time, kind of just really not having direction, was to pray. So I prayed, and after I prayed, after 3 months, I found an answer, and it was, Hilgardt, go to America where the dreamers and the doers and the givers are, and use your training to help them be proactive in the way they plan out their dreams. And that's kind of where this whole idea of becoming a planner was birthed inside of me. Well, we'll fast forward now. About a year after that, we came back to the States, and Yanis was, as an occupational therapist, had a work visa. And the company she worked for was promising to sponsor us for a green card. So I wasn't able to work. So for the first 15 months in the United States, it was kind of tough, but I did two things. Every day I would get up, and I would study the tax code, and I would study the Bible. There are two things certain in life, death and taxes. One of the things that I discovered in studying the tax code, it blew my socks off actually, because I knew the tax code in South Africa. But the United States tax code were very, very unique and special. There were very uniquenesses in it that is no other place in the world other than in America. And I also discovered something very, very profound. I studied the tax code because I knew that he who understands the code will win. Because I figured I was going to be in business for myself one day, and if I know the tax code, I will win. And 26 years later, financial planning The greatest optimizer, I'm going to talk to you about optimizers. What can you do to optimize your financial planning and your wealth? But one of the greatest optimizers is this conversation about tax planning. But yet, very, very few people really experience and see it in action. So tonight, I'm going to summarize for you 3 areas of tax planning. The first area I'm going to talk to you about is how do you reduce your income taxes this year? Okay? Then I'm going to talk with you about, or share with you some ideas about how you can become more tax efficient in the way that you create and grow your wealth. Well, everybody still grows their wealth right until they die. You don't stop growing your wealth. And then I want to share some ideas and concepts with you how you can avoid some taxes, specific taxes that you can avoid. And the 2 kinds that are very voluntary is capital gains tax and estate taxes. So those are 2 voluntary taxes in the sense that you don't have to pay them, you can plan them away. So are you ready? Are you strapped in? Are you enjoying your meal? All right, so let's go. As we're talking about some ideas and concepts, it's pretty simple. Let me first just understand, how many of you here have businesses? Put up your hand high, please. Okay, fantastic. How many of you here are retired, no business? Okay, so all of you got businesses, that's good. All right, so simple ideas, but still yet profound. A health savings account. Look, if you can find a place in the tax code where you can make a contribution for your own future on a tax deductible basis, let it grow there, use it in the future, and when you pull the money out, it comes out tax-free. It doesn't get better than that, right? I get a tax deduction when I put money in, it grows tax-free, and whenever I use the money for my future, I can use it tax-free. It doesn't get better than that. There's only 2 places in the tax code that I know that idea exists. The first place is health savings accounts. The only problem with health savings accounts is that I can't put a ton of money in there. I would love to put as much money in there as I can. $7,200 a year is what you can put into a health savings account for a family. $8,200 if you're over the age of 55. If you're a single person, it's half. But you have to have a kind of, that's no problem, come on in. Come on in. You have to have a high deductible insurance plan, right? So your deductible as a family is going to be at least $2,800, right? So health savings account. I know for some of you tax wizards in here, this is very elementary, but I will tell you, about 75% of the time when I bring up this topic, people have not implemented a health savings account. Great idea, great tool. Second one is qualified plan design. What I mean by that is these are the things you would call IRAs, 401ks, and on the go. I joked with Jeremy the other day, one of our advisors said, Jeremy, it's IRA, SEP IRA, it's simple IRA, it's solo 401k, it's 401k, it's 401k profit sharing plan, and I can go on and on and on and on with you, okay? Judy knows what I'm talking about. All right, here's the deal. You could put as little as $7,000 a year into an IRA, and you can put as much as $500,000 into one of these plans. The differences I see is that most people are aware of an IRA and most people are aware of a 401k. And that's kind of where it stops. So if you just understand, or if somebody works with you that has the bigger picture in mind and understand the reason you want to use these tools, you can absolutely optimize what it produces for you. When you think about these type of tools, what's pretty important too is that for company-sponsored plans, you have to share it with your employees. So there's much more that goes into this discussion than just the pure amount of money you can put inside of those. Okay? By carefully looking at this area, you can optimize, and you can optimize big. So this is another area to talk about. Employing your children. Employing your children. Who here has ever employed their children in their practice? Here we go. Okay, you're looking at the fruit of me employing a child. This guy right here started working in this practice when he was 8 years old. And so his brother, and so his younger brother. Here's the coolness of this idea. You could pay your child up to $12,950 a year, deducted from your business expense, They put it on their tax return. They get a standard deduction of $12,950 and they pay zero tax. Now for me, 3 kids, I just created for myself about a $40,000 income tax deduction every year. If your tax rate is 30%, that's a $12,000 cash savings immediately. But there's something more that comes from that. It's the family stewardship training that you're doing when you do that. Your kids are working for an income. They get involved in understanding business. They understand how to serve people. You're passing on that legacy of teaching them how to work well with money. When they receive the money gets used, and you can take that, turn around, put it into an investment vehicle that grows completely tax-free for the rest of their lives. That's the second area in the tax code, where you can take a deduction for what you put in and grow the money completely tax-free. Actually, some of those ideas you could do it for 2 generations. Okay? Fantastic idea. I'm going to introduce you guys to Ben here in a second, but Ben's dad, Rick, has been a CPA partner. Their firm helps us. I went to him about 15 years ago, and I said, okay, tell me the details and help me implement the details right. So there's a little bit of details and there's things that you need to implement to do this right so it doesn't become an audit risk. But I call this street wisdom. Street wisdom. Yes, Judy?
Are we allowed to ask questions?
Sure, quickly.
Well, I just want some more information on that health savings accounts.
Okay.
Because I thought that had to be through the employer, and they're claiming that you're saying that we could do that ourselves?
Yes. Your niece and I have a health savings account.
Okay, so we'll be chatting later.
We'll be talking about that.
Have that, right.
All right. Write that down, okay? Write that down so we can talk about it. Charitable giving strategies. Any of you guys enjoy giving money back to community and charitable organizations? Yes. Here's the basic idea. With standard deductions coming up now to $12,950 per person, or $25,000 for a couple, most folks who have itemized in the past don't itemize anymore. Okay? Because if you may be giving $10,000 a year or $15,000 a year, things like your property tax and your mortgage interest are typically what builds up to become your itemized deductions. So if your itemized deductions is not higher than $25,000, $26,000 as a couple, you lose those deductions. So how do we get you back into being able to capture those deductions? We use a simple tool. It's called a donor advised fund. A donor advised fund. We bundle your charitable gifting together. We say, like, if you're going to give $10,000 or $12,000 or $15,000 a year as an example, let's do that for the next 5 years together. We move money typically from a taxable environment to this environment. And in that 1 year, we create a $65,000 deduction for you. Now you're way over the standard deduction, and now suddenly your property tax and your mortgage interest adds up into it, and now suddenly we've created an $85,000 deduction for you. Okay? So how you do your charitable gifting and the tools you utilize, if you just put a little strategy in there, it's amazing what can happen to your income taxes that year. Which brings me to this concept. When do you speak to your tax planning professional?
When I can get them on the phone.
When you get them on the phone, okay. Most people speak to their tax people in March and April of the following year. When you speak to your tax people then, what can they really do for you? Not much. About nothing. Maybe 1 or 2 things. If you want to use some of these ideas and concepts, the first thing that needs to change in your mind is that you need to be thinking tax planning and not tax preparing. Go back to my story. Use the tax code not reactive or responsive, but proactive. The moment you do that, between now and the end of the year, I cannot think of a better time to sit down with us and visit and look at your situation to see what we can do with your tax bill next year. There's normally a lot of good things we can do. Right here, I got my secret sauce, which is 50 tax planning ideas. We will be here for breakfast tomorrow morning. I will be serving pancakes. No, but there's 50 ideas you can utilize to be proactive in your tax planning. Okay, so here are some. Charitable giving. Using your home for entertainment. Section 280A. This is a cool idea. This past weekend I was with good friends of mine in North Carolina, and one couple lived in Augusta. And these guys in Augusta lobbied the IRS and passed this tax code. Because here's what's going on, right? What famous tournament, golf tournament, happens in Augusta? Okay? Augusta National, right? The Masters. What happens during that period of time? These people become rich. They rent their house out for 2 weeks. Everybody wants to go to the Masters. They collect rent when they do that. And what they did, they lobbied the IRS to give them the ability to rent their house out for up to 14 days and pay 0 income tax on the rental income. Now, in your businesses, do you ever have a board meeting? Or have a team meeting? Or have planning meetings? All right, so here's the deal. You rent your house out to yourself. You pay a market-related fee for what it would cost anybody else to rent your house. Make sure you have a nice house. When you do the research, you'd find it's anything from $1,000 to maybe $3,000. Have 14 corporate meetings in the year. So 3,000 times 14, $42,000. Deductible to my S Corp, not taxable to me personally. We just created a $42,000 income tax deduction you didn't have last year. But the devil's in the details. It has to be documented. You have to think through this carefully. This right here, this is worth about $15,000 in tax savings. Okay. The source of your income. There's some of you here that doesn't have a business. I would first say, if you're retired and you don't have a business, get one. Because the moment you get a business, you can expense. And expensing is still one of the coolest ways to reduce your income taxes. But if you don't want to get a business, then I would say, be very careful and strategic about the source of the income that's coming into your life. And when you're retired, you can actually think about this or plan this out ahead of time. I'm going to talk with you a little bit more about this specific topic when we talk about how we create wealth in the most tax efficient ways. Well, I got a bonus for you. Ben, you and I sit down a lot every year and we kind of bring ideas to forth and we think through, hey, what's new, what's going on, what other ideas? In say 3 or 4 minutes, what other ideas have you seen that you've been implementing a lot with your clients? Just stand up, it's fine.
Hello, I'm Ben.
Hey, Ben.
Hilgardt, my dad, I've known each other a long time, and Hilgardt and I have known each other for quite a while. A lot of clients in common, we do a lot of planning together. I also like Hilgardt, have an accounting degree, and don't like accounting. But that's, my dad kind of tricked me going into this, but I like what we do. It's not accounting. I like to deal with people and save them money. Same thing as you.
Amen.
So he called me this morning and he said, hey, do you think you could talk for a couple minutes tonight? And I was like, sure. So all the advice I have is going to be really only good for business owners for the most part. So if you're not, I'm sorry, but I will do my best. So how many of you own businesses again? Okay, just a good then.
Okay, one more question.
Yes.
How many of you think you should own a business?
Sure. Okay. For you that own businesses, how many of you got an employee retention credit? Do you know? You did? So for those of you that didn't, this is definitely something you should look into. Everyone was aware of the PPP and what happened with that. The ERC, employee retention credit, very similar in the way you qualify to get it as PPP round 2, but it was much less well known. You're probably getting spam emails from companies all the time right now about this. Sometimes they call it ERTC, but you just ignore it as a spam. But it is a real thing. The way to qualify, you have to have a decrease in sales from any quarter in 2021, if you had a 20% reduction in sales in any quarter, you qualify. So that's the general gist of it. If you want more information, I can give you more. But that's how you qualify. If you do qualify, as long as you kept employees around, basically you can get up to $15,000 per employee per quarter as a credit. So it's big money if you qualify. So ERC was one thing that I said is huge. We've been talking to all of our clients about. But the main thing I wanted to talk about really is just philosophy of IRS risk and tax philosophy in general. So most CPAs, when you talk about them, when they talk about this, they don't think the way that business owners think. They don't think in a normal strategic person type of way. So what I want to explain to you is IRS risk. We put all IRS risk in two different categories. Category one is you do something that's an audit flag. Something that gets a human being at the IRS looking at your tax return saying, we need to ask them some questions. Category two is things that under audit, the IRS, there's risk that they will overturn what you did and say, now you owe the original tax plus penalties and interest. If you are very careful about category one, then you can be as aggressive as you want in category two. Because the odds of you getting audited, if you don't do anything specific to flag yourself, it's like less than half of 1%. And I know some of you are thinking, oh, but they're about to hire 84,000 auditors. First of all, they're not going to find 84,000 people who want to work for them. That's point number one. Number two, okay, maybe that increases your risk to 2% or 3%, down from 0.1%. Who cares? It's still such a small percent chance. So like a couple of the things I just wrote down on the way here of what would get you audited, it's very specific things. Number one, the IRS puts out lists of things that they don't like, but they basically say, if you're doing this, you're probably going to get audited because people use it too much. Like captive insurance, anything to do with easements, airplanes, big airplanes, boats. You put those on your books, you're just asking for an audit. Or anytime other things are like if there are numbers that contradict themselves, like you put one thing here and one thing here, and their computers can just automatically say, oh, this doesn't tie, there's something wrong. That's obvious, but you're saying it. And then if you just got certain ratios that are super out of whack, then that could potentially cause an audit. But that's the ratios thing. I think we're giving the IRS a little too much credit in thinking that they're looking at ratios. But it's a possibility. Outside of those things, your odds of getting audited are so low that the main thing I want to communicate to you today is when you're talking to your CPA and you ask them, can I do X? Especially if you're talking about like a deduction in your business. Try to read between the lines of what they're saying. If they're like, oh, yes or no, the real question you should ask them is this an audit flag if I do this? Because if it's not an audit flag, then what you know is if I just vary this in the expenses of my business, the odds of this ever becoming a thing that matters is 1%. So if it's a 1% chance, that's the chance that you're taking. The other thing that you should really ask your CPAs when you're asking them for tax advice is, first, is it an audit flag? Number two is, what's the tax effect in dollars of doing this or just not doing this? And my favorite example is, if you own an S-Corp, there's this whole conversation of how much you pay yourself on the W-2 versus your distributions. Generally, there's not much of a back and forth conversation with your CPA about that. But if there hasn't been, you should ask them about that. And if ever your CPA comes and says, hey, you're making more money now, you should up your salary. Make sure you ask them, okay, well, how much tax is that going to cost me and why? Why do I need to up my salary? And I can't say super broad rules because there's a lot of conversation I would want to have to be comfortable giving you like an opinion on yours, but in general, if you're paying yourself already 6 figures on a salary, and then your CPA says, you should go up to 120 now, or 140 or 180, it's probably being really conservative. So
Yes.
I'll leave it at that for the moment, but ask them, make sure you know what the tax effect is, because it's huge. It's like federal income tax plus 15.3%. It's a really big deal, the difference between distributions and payrolls.
Awesome.
And then 2 quick little things. What
Yeah.
you said about how to get charitables back into deductible. If you own a business and you're under the standard deduction limit of $24,000, one of the things we always tell our clients is just put it in your business and call it marketing expense. Because for the most part, a lot of, not tied to a church or something like that, but if you're sponsoring a golf tournament, they give you a charitable receipt, I would still just put it in marketing expense, because that's always deductible, whereas charitables are not always deductible. Or a lot of things that are charitable giving, it's usually better to do it as a marketing expense in your business. And number two, when you talked about the donor advised fund, there's another thing you can do with just bunching of itemized deductions, where if you look at all your itemized, which is like mortgage interest on your house, and your property insurance on your house, and your charitables, if you do $20,000 every year, you're never getting any benefit. But if you just bunch them in every other year, then you can get over the limits, even without a DAF, or with the DAF. If you do the DAF, then in that year, you should pay your property tax on your house for that year and the next year, and put them both in that 1 year, because you can pay it early 1 year and pay it out even in January the next year. You can bunch them all together and then have 1 year where your itemized are really low and you take advantage of the standard.
That's a good one, Ben. Thanks for reminding me on that. That's a great one. See, this is why working together as a team is much, much more beneficial. So thank you. That's awesome. That is fantastic. All right, so let's move on to the next area I want to talk about, the tax efficiency and the way you create wealth. And this is frankly what absolutely blew my socks off when I came to America and I read the code. And what's interesting in the investment world is most advisors would say to you, well, listen, the rate of return is it. That's what's going to make the biggest difference. What I discovered in understanding the code is that, let's just say I've got this magical Vanguard fund and it's paying 10% interest. The amount of money that you will have in your pocket is radically different depending upon the tax vehicle you're using to grow that wealth inside. So simply said, there are 3 tax vehicles. The first one in the middle is taxable. This is typically your brokerage accounts, your savings accounts, your cash accounts, right? This is areas that as your money is growing in this environment, you're subject to a tax every single year as it grows. It's the least tax efficient environment. The second environment is what we call tax deferred. Typical most used idea here is the 401k or IRA. It grows inside of these vehicles until the time that you pull the money out. It's deferred until you pull the money out. This is more tax efficient than on a taxable basis. And then the third one is tax-free, right? I joke and say, English is my second language, but tax-free sounds better to me than tax-deferred or taxable, right? Tax-free. And in here, there's a lot of different tools, and we're going to talk more about these tools, but here's the thing that I find most of the time. When we look at, if we look at a person's wealth, we actually, in the way that we organize it, we indicate the percentage that's in a taxable environment, tax-deferred, and tax-free. And Hilton is helping me a lot with that. So Hilton, what would you say is the average percentage of people's wealth that sits in the tax-free environment?
We're at 5%.
5%. 5% of a person's wealth sits in a tax-free environment. And why do you think it's only 5%? Yes, go ahead.
We don't know.
You don't know. Exactly. The moment I saw that, I said, woof, there's a future for me in financial planning. I'm just going to help people become aware of these areas. Okay? So let's talk about it more. I'm going to focus on the tax variable areas because that's the one that's most tax efficient. So the Roth IRA or the Roth 401k, right? A great, I'm not going to use the word loophole, but a great adjustment to the code is when you make a certain level of income. I always do this on the golf course, by the way. I play golf with an executive. He's making good income, say $300,000 a year. I say, are you putting money into your Roth? No, I can't. I make too much money. I said, yeah, but are you putting money inside of your Roth, inside your 401k? No, I cannot. I make too much money. No. There is no limit of your income to be able to contribute to a Roth feature inside of a 401k plan. All right? Beautiful, beautiful nuance that passed through. Interest from municipal bonds. I bring this up again because what happened in this year is that most bond funds or bonds have gone down in value by probably around about 15%. It's a very, very difficult year this year to navigate through the markets and go find where there's growth. Well, when bond prices go down, their corresponding yield or interest goes up. So before this year, Bonds was not paying any kind of yield or interest. But we are finding bond positions right now that's paying about 7 to 10%. So bonds actually is becoming a great opportunity again as a result of this markets. Now, municipal bonds typically pay lower interest, but I just checked. The yield that you can get, or the interest rate from a 5-year to a 10-year mini bond, is anything from 2.7 to 4%. And it's a very, very low risk, and it's tax-free. And so if you get a 4% tax-free income, the tax equivalent of that is around 6%, depending upon your tax rate. Not a bad idea. You should look at that again for those of you who are closer to retirement or more conservative in your approach. We can grow wealth inside of college-oriented funds to help fund our grandkids' education and our children. It's probably more grandkids or your children if you have. You can do this inside of a tax-free environment utilizing 529 educational plans. 529 education plans do come with a little bit of a sting, and that is that if you don't use it for education, you will be taxed on the growth as well as a 10% penalty if you pull the money out for any other reason other than education. So don't overdose on this idea. Yes, ma'am.
So what if you're hoping for grandchildren
Yes.
and you start doing this and then you get new grandchildren?
Yes.
Is it transferable
Yes.
to a nephew?
Yes. Yes, it is.
Okay.
Yes, it is. Beautifully transferable. Even for parents who put monies inside 529s and have some 529 money available after their children go to college, easily transferable to the grandkids. By the way, probably the most profound estate or inheritance tool that you can leave your grandkids is an education.
I'm saying if I don't have grandchildren.
I understand. You will create an account. You will put it in the name for the benefit of your child. But if your child has grandkids, you move the beneficiary of it to your grandkids. If they don't,
So my child's, but how does my child have grandkids if they don't have kids?
your child's children. If your child does not have children or you have grandchildren, then you can still move the beneficiary of the 529 to your nephew and your niece.
Okay.
Okay? You can move it back to you as well. The return of cost basis in taxable accounts. When you plan your income stream, remember I said your tax liability is dependent upon where your income comes from, the source of the income. So one source of income is money coming out, we call it the basis, the original contribution amount in a brokerage account. When that money comes back to you, it's tax-free. So how you plan the income stream in your life is critically important. Okay, it comes back down to planning that it helps you determine the source of the income that you're going to be pulling from. So if you have other big events happening in that year that makes it taxable, but you still need income, you ought to be focusing on areas that you can pull money from income tax free. Life insurance death benefits, the only problem is you have to die. But here's another one. If we pull income from a life insurance policy, it is also income tax free. Also income tax free. That meant that you have created it. Probably this idea works well for people below 55, and younger. But you got to create it inside a policy that has a death benefit, but also we create these to produce supplemental retirement income, and income pulled from an insurance policy, not death benefit income, it's also income tax free. So those are your 6 areas that you could utilize. We see predominantly 2 or 3, that's it. So by simply knowing and thinking through how you do this, you can create your wealth tax-free. You see that? Okay. Any questions about that? All right. I talked a little bit about Roth. Do you know there's a difference between being able to contribute to a Roth or being able to convert to a Roth? The ability to contribute to a Roth is a function of your income limits, right? If you're married, if you make more than $214,000, you cannot contribute to a Roth. But does that apply if you want to talk about converting to a Roth? Answer is no. You can convert to a Roth without any income limits. So that brings the question, should you convert to a Roth? Right? Very, very important question. Should I convert to a Roth? Answer is before we answer that question, let's just ask this question. Should I Roth or not? Should I convert to the Roth? What is this all based upon? It all comes down to your tax rate today versus your tax rate in the future. If your tax rate today and your tax rate in the future is exactly the same, whether you save in a 401k or in a Roth, it's the same exact answer. Now, when I was young in my practice, I needed some real practice, and the way I practice is I work with engineers. It's made me pretty good these days because they would kill me. Tom, they're so analytical, they would kill me. And when I made that statement, these guys were basically throwing lunch at me. They're saying, you're completely wrong. So I had to whip my calculator out and show them that. Okay, if your tax rate's the same, whether you save pre-tax or after-tax, tax deferred or tax-free, same result. So you have to look and see where are you going to be in the future, right? You know your tax rate now. What's your future tax rate going to look like? And when you look at your future tax rate, you ought to understand that there's 4 things that influences that. I'm going to go over here in a second. It's the bracket. Okay, there's 4 things that influences your tax rate today as well as in the future. What is your income? What does your deductions look like? And unfortunately, what I see is that deductions are being changed on an ongoing basis. What does the rate look like, right? The bracket, the rate, the deductions, the source of the income. Those are the biggest factors that determines your tax rate. So the problem is we don't know the future, but we can see the way the code is written. Your deductions, as an example, goes away for the most part when you get older. Okay? Your income normally goes up towards your retirement because you're becoming smarter and better paid. So these things is influencing more probably a higher tax rate situation, but you know what? They said when you retire, you're going to be in a lower tax bracket, right? Can you find they for me? Can you find they for me? Okay. Where does that come from? You thought that, yes.
I've been taught I was wrong.
Okay. Well, Judy said it. Where does that come from?
Well, in 1980, when all this started,
Yes.
told
Yes.
I do 401k. That was what you wanted
Yes.
to do.
And you know why?
Never a talk about a Roth.
Well, there wasn't a Roth available then, but also the income tax rate was at 72%. So when your income tax rate is at 72%, it's double than what your income tax rate is now. The chances that you will be in a lower tax bracket in the future has to be better because you're taxed at 72%. Today, our tax rates are lower. It's 37 is the highest rate. And we're trending up. So this is the importance of understanding the differences between these. Does that make sense to you? Okay, let me just go through this quickly. Should I convert to a Roth? The answer is it depends. It's unique to each individual family. And if you are going to do a conversion to a Roth, please don't do this by yourself. You will get hurt. You have to do this very, very carefully. Ideally, in a year in which you do a conversion, you want to create large income tax deductions. Because when you do a conversion, it adds to your taxable income and your rate goes up. And you are undoing this idea of a lower tax rate in the future. So you've got to be very careful how you do this. Okay? Don't do this one by yourself. All right, so I shared that the way that taxes goes up in the future is brackets, deductions, new taxes. We call it legislative risk. Best way for me to describe legislative risk to you is that our current country debt is about 31 trillion, right? And rising. Are we slowing down the amount of money that we are spending at the moment? Where is this money going to come from just to pay the pure interest on the debt? Okay? The government can move your cheese like that. What can you do about it? You can vote on a ballot, Democrat or Republican. That's about the level of control you have, right? Okay. But you can change the source of your income, and you can become a little bit more strategic about that. And that's what I'm saying. That's legislative risk, okay? Okay, anybody sleeping yet? You guys want to talk about estate taxes quickly and capital gains tax? Okay, Susan, we should have some iced tea next time, not wine. Yes. Capital gains tax. What is that? You buy a piece of land, You have a high, you buy stock, and the value appreciates, right? And then when you sell it, there's a tax on the gain of the capital gain of your asset. What is that tax? Depends. Could be 0, could be 10, could be 20, it could be 23.6. 23.6, yes. That's a capital gain. Now, here's the good news. That tax is voluntary. You don't have to pay it. There's actually 4 things you can do. You can pay it. Most people that don't understand that you can do these other things, they just simply pay it. You can defer it. You can reduce it, or you can completely avoid it by the way that you plan. That made me very, very excited when I studied the tax code. Wow, I can avoid a tax completely. Okay? The same thing is true with estate tax. An estate tax is when I transfer my wealth to my children. If you're beyond certain high levels, you're subject to an estate tax. Okay? But that is voluntary. I mean, we work with several couples that have net worths of 40 million to 200 million. Right? We work with an NFL quarterback. Okay, he's in that area there. But we plan his estate in such a way that he pays 0 estate tax. You can plan it away. You just have to do some advanced tax planning strategies.